Good afternoon, everybody. It's great to be with you today, and to KLA staff, Matt and team, thank you for the invitation to share a few thoughts and ideas with you. As Harry said, this has been a pretty wild year, hasn't it? We've had a lot of things we've had to navigate as we've come through the year. I'm sure we're not done with some of those, but I hope that as we all reflect on what we've been through as an industry here over the course of the last 18 months, again, keep in mind, we've had two black swan events. Again, starting with the Tyson fire in August of 2019 and followed up with COVID that we've had to deal with here in 2020. But I think as you look back at this time period with everything that has happened that has impacted our industry, I take my hat off to each and every one of you for being able to navigate these times. Again, it's been unprecedented to see what these markets have done, how they've worked through it, how each and every one of you with your various production systems have had to modify marketing expectations that you had in order to work through this scenario that's been put in front of us. That's not only happened at the beef industry sector. Obviously, we've been through exactly the same thing at the retail and food service markets. And I think if you look back at it, one of the things I'll touch on in a little more detail with you today, but I think it's important before we really get into the data for me to just share with you, beef demand was phenomenal in 2020. Again, we had the best beef demand we've had in over 30 years in 2020, in spite of everything that we've had happen to us. So when you sit back and you think about where our industry is, the first thing you have to ask yourself is, am I in the right business? Are we doing something that consumers see value in, that they appreciate, that they respect, and that tastes great? And I think based on the way we see consumers continue to vote for the product that we're producing, the answer to that is very clear. We are doing a wonderful job. I would just say, keep your foot on the accelerator and continue to do those things that have helped differentiate our market in the protein market. Again, beef has differentiated itself from pork and poultry over the last several years as we become much, much more quality focused. So I just say, keep that in mind as you look at some of the data with me here today. I'll be going through this fairly quickly, and we'll take time when we get finished up here and have plenty of time for questions. I would just give you a quick overview of Dr. Art Douglas's comments. I know most of you are big believers on how good a job Dr. Douglas has done for us and as for our industry here over the last. Art has been with us now for 43 years. So he's done a great job. He paved the way for this long range weather forecasting. And although he's not always right, he's been very good here this last several years. And Dr. Douglas had told us 2 years ago that we were going to be transitioning from El Nino back to La Nina. And La Nina would gain strength as we move through 2020. He still thinks it's going to be strong through the first quarter of 2021. Unfortunately, he thinks that it may last clear into 2022 or through the second quarter of 2021. So that's something I would say we just have to keep in mind. If we stay in this La Nina weather pattern, as you can see, looking at the Western United States, we've got a lot of areas in the West that are pretty stressed. Now, Kansas has been fortunate. We've gotten some pretty darn good moisture through this fall in Kansas. Oklahoma's been wet. Even down into Texas, we've got some very good moisture through some of our grazing areas over the course of the last 30 to 60 days. So you're not feeling it so much there, but I can tell you where Rob mentioned our family operation is in Northeast Colorado. We've been in two of the toughest years of drought that we've been in since back in the 50s. And that's not very far from the Kansas border. So it's not very far away where some of these areas have been very, very difficult. So just keep that in mind. The reason I'm spending time with you on this is when you see how much of the country has been stressed and you look at beef cow slaughter, as I'll show you in just a few minutes, you'll understand why we're harvesting more beef cows. We've got a lot of areas that have been stressed. We've not had any real issues with our production as far as our grain production is concerned. We've had very good corn crops again, good soybean crops. But as we've looked at this year in total, I think if you go back, and I want you to focus your eyes on the top chart. You look at the top chart there with stocks to use. Look at the bar in here. Back in May and June, the USDA told us we'd have a stocks to use ratio of somewhere around 22%. Look where that is today. It's at 11%. Again, they've continued to find less stocks, less supply. They adjusted the numbers as we came into this year, adjusted the yield down, et cetera. The bottom line is we cut stocks to use in half. And again, that's why we've gone through this situation. The corn prices are trading today $1 higher than they were on August 1. Is where futures are trading today, and we've got the strongest corn basis that we've seen in years. So today we're looking at elevated cost of gains on top of 90 cents a pound. I think would be pretty common as we look across the country. We're going to have to deal with this through the first half of the year. We've got to buy more acres as we go through the spring and early part of the summer. The market wants to see us buy more acres. Again, as a result, you're going to have higher annual average corn prices this year. Although if we are successful in buying an additional 3 or 4 million acres of corn to be planted this year, we'll likely see corn prices move back below $4 a bushel into the second half of the year. So just keep that in mind as we move forward out here. Again, we've got some areas in here that we've got to work through. We need to buy more acres, and I suspect we will as we go forward. We think about the slaughter numbers out here, the situation I mentioned. You can see beef cow slaughter is up about 3% this year. Contrast that to dairy cow slaughter here on the bottom. Again, I think the big difference there is the beef industry's been dealing with drought that's had a major impact in the western United States and very limited profitability. Our cow-calf producers just aren't making any money. Again, when we look at average profit margins this year, we're basically at break even. And this has been the case for the last 2 or 3 years. There just hasn't been enough money made on average to hold the cow herd together. That's why we're seeing the contraction. You look at the dairy cow slaughter, on the other hand, milk prices when we're in the middle of COVID, when you all remember back in that time period when all of these restaurants were closed down in March, early April, you remember those pictures on your TV screen with the spigots opened up on the milk trucks, dumping milk out in the pasture, out in the field, because there was nowhere to go with all the restaurants closed. Well, we reintroduced people to consuming milk at home through COVID, and milk demand, fluid milk demand, has really improved as we've come through COVID because of more and more people at home. In addition to that, exports have picked up substantially, and the result was milk prices went from $11 back in about the 1st of May to $25 in here earlier this fall. Now they've softened up here recently. We're back in the teens, but for the most part, most of our dairy operators are making some money for the first time in quite some time. So the dairy cow herd is actually going to be up. I would say it'll be up 25 to 50,000 head when you see the report that'll come out late January from the USDA. And again, you can see what these numbers have done as we've worked through the situation. On the beef cow side, on the other hand, we're looking at another year contraction with beef cow numbers. When we get the government report out in late January, it's going to show that another 300,000 fewer beef cows, maybe as much as 350,000 fewer beef cows as we come through here. Going into 2022, I would expect with the dryness we're going to see through the first half of this year, you need to anticipate that we'll be down again in 2022. So the result is that the nation's beef cow herd is going to shrink about 1 million head over this couple of year time period. You got 1 million fewer beef cows, that means 1 million fewer calves out there, which means eventually you're going to lead to about 1 million fewer fed cattle to be moving through our production systems. So that will be the dynamic that these markets are looking at. And for those of you that have been following our updates, our reports, our long-term outlooks, I think we've detailed that for you quite extensively in here in the last few months. So you're prepared for the change that these markets are going to go through. That's the smaller calf crop that's coming that I just alluded to. And again, one of the things that we've had to deal with this year because of COVID, I want you all to focus your eyes on the red line here. That's carcass weights. Look how flat carcass weights were all the way through 2019. Now remember, this chart starts from July and goes through June. So as you came through this last year in 2019 and 2020, weights have been very, very flat as we move through here. We didn't get the decline in weights that we would normally see. And that's been part of the scenario of why these markets have been so slow and really been able to recover as we've moved through this front end supply. We've still had so much weight. Normally we would see weights drop about 52 pounds from this fall high to the spring low. I would say based on the setup that we have this year, again, if we can see the fed cattle market get profitable in here in the first quarter, we will in fact see at least that seasonal decline in weights, maybe a little bit more as we go get deeper into May or even early June. So we should follow a normal seasonal drop in weights as we go through the year. Now remember 2021, the numbers that you're looking at in 2021 are skewed a little bit because we weren't able to harvest the numbers back in here in April and May of this last year. 2020 would have been our largest supplies and our largest slaughter without COVID for this entire cycle. But because of the COVID situation, again, 2021 will likely end up being that peak slaughter and peak production. If we get profitable enough in here, the production won't be up the full 2% in 2021 because carcass weights will decline a little more than that. But I think you do need to anticipate that production will be up at least 1% as we come through the year. Now, this is what I was alluding to. Look at this drop in carcass weights that we go through or slaughter as we went through the spring. Remember what happened in March. Once y'all find a black line, look what happened in March. Remember, the government closed the restaurants in March. That created a run on retail, which forced these packers to crank the slaughter level up in the month of March. I mean, that was a massive harvest level we had in the month of March. Then we started seeing plant workers get sick as we turned the page into the 1st of April, didn't we? And that's what led to the big decline in slaughter in April and May. We just couldn't keep the workers in these plants healthy. And I'd take my hat off to the packing industry. I think they've done a wonderful job in here of responding to the situation. Again, it was a real issue for us in April and May, but we had to figure out how to keep these plant workers healthy, didn't we? More spacing, more PPEs, petitions in a lot of these fab floors. We had to slow things down a little bit, no cross-contamination between workers. And again, to see the slaughter levels come back the way they did, where we were able to harvest at 95 to 97% of pre-COVID levels through in a 5-day harvest week, that's what we did all the way through here once we got to June 15th. So that created a major problem for us in April and May. I don't think I need to remind you all that we backed up 1 million head of fed cattle in April and May, 1 million head. And that's what we had to work through here over the last several months. To give you a little bit of an insight on that, we estimated that between 3 and 4 million head of hogs were backed up during the same time period. 3 to 4 million. So they had a very similar scenario that we did in the beef industry to work through. So we had lots of cattle to work through, and we had record heavy weights. And that's been the combination that we've had to deal with through the second half of the year. Now focus your eyes on the orange line here. The orange line is the harvest forecast going into 2021. And again, these are the numbers that were placed against that time period. We placed about 550,000 more cattle in the third quarter of the year. So July, August, September, we placed 550,000 more cattle into the feed yards. Now in October, November, December, we're going to place about 550,000 less cattle into the feed yards. So again, that's totally offset each other. By January 1, cattle on feed numbers will be down about 1% on January 1 of 2021. So bigger first quarter supplies, and then you transition into much smaller supplies as we move on into the second and third quarters of the year. And that's why you see the premium in the futures markets that are brewing out there. That's why you have June cattle today is trading at basically 114. The markets can see that we're going to have smaller supplies by the time we get out into the spring and summer, and that'll carry on into the fall as we move into this phase of the cattle cycle. So from a harvest level standpoint, we'll harvest about the same number of fed cattle in 2021 that we did in 2019. It'll be pretty much the same number. But look what harvest numbers will do as we move through 2024. We'll see about 1 million head reduction in harvest numbers as we move into the middle of this next decade. So think that through. Remember, we've been in a situation in here that we haven't had enough hook capacity. And this is showing you the transition that we went through. Back in 2011, 12, 13, 14, there weren't enough cattle out here to keep these packing plants running. We closed significant numbers of packing capacity as we came through this time period. Again, you can go through and name with me all the packing plants across the United States that closed through this window. Then we get into this big expansion phase or rebuilding phase that we went through the industry. And you can see we've had 8 to 10% more cattle than what we had hook capacity to be able to harvest those cattle in a 5-day, 40-hour week. So this is where that term leverage, as we coined that term back in here in 2015, this is why we coined it. We knew we were going to go through the transition. We just didn't think it would be quite this abrupt. And again, it's been pretty significant as we move through here. Well, if you're with me and you look at a reduction in the fed cattle supplies that we'll see through the next 3 or 4 years, the industry will gradually start to get some of that leverage back. So some of these big margins that you're seeing at the packing level today, packing and retail, those will start to distribute themselves more equally back through the production systems. I'm talking about cattle feeding, stocker operators, cow-calf operators, seed stock operators will be able to harness a little higher percentage of that total value that's being produced across the industry. So that's a little longer term view without going into so much detail here, but hopefully you can see what the big picture of that looks like. I don't see any real significant expansion in the packing industry taking place. We've got one plant that will be opening up in the first quarter. It's about a 500 head plant right over here in Missouri. That will be helpful. We've got another plant that will be opening up, but it looks like probably in the third quarter in the Pacific Northwest of Idaho, and another one before the end of the year in that same basic region. All of those plants are going to be approximately 500 head a day. So I don't see 4,000 head plants being built. In fact, I don't see any of those plants being built as we look to the future. I would look for a lot more of these smaller plants 1,000, 1,500, 2,000 head a day plants. If we're going to see bigger plants, that would be about as big as I would anticipate. Look for more investments in technology to go in these plants, more robotics, more cobotics, that type of thing is where we'll gain some efficiency as we look forward. Now, what about the global marketplace? Let me just remind you all before we get into this data, how important global trade is to the U.S. marketplace. When we look at pork production in the United States, between 25 and 28% of all the pork we produce in the U.S. is exported. On an annual basis, 17 to 19% of all the poultry we produce in the United States is exported. And if we add beef and beef byproducts together, we're talking about 13 to 14% of our total beef production. So for those of you out here that are in the fed cattle marketplace, 20% of the value of that fed steer or heifer that you sold this week was generated out of the export market. That's a big, big number. And again, as we look to the future, I want to remind you all that the U.S. is the largest beef producer on the planet. We're the largest poultry producer and the third largest pork producer. So these global markets are extremely important to us. We will export just shy of 19 billion pounds of protein this year. Put that in perspective, that would be the equivalent of 45 more pounds of protein per person in the United States if we had to absorb it here. So hopefully that gives you a feel why we focus as much of our attention on global trade that we do. Obviously, when we couldn't produce beef back in here in the spring, production was down 30 and 40%, prices doubled through that time period. You're going to see exports show you that. Exports will end up being down slightly this year, but I want to remind you that exports in the first quarter were strong and exports since August, September have been strong. The reason that we're down for the year is because of what happened in that second quarter and early part of the third quarter of the year. We expect that exports will be up easily 5% this next year. I would guess they'll be up between 5 and 10%. Imports will be down. Again, Australia, one of the largest importers of beef into the United States, their slaughter is going to be down about 15% this year as they go through the expansion of their herd. So bottom line is we won't need as much of that product from the global markets to help feed our consumers in the U.S. this year. So the export side looks very positive. Exports will be bigger, imports will be smaller. Again, the balance of trade, if you look at the two lines up in here, you can see that export and import tonnage will be nearly identical. They'll be basically at the same price level, but the value of our exports per pound are significantly higher than the value of the imports that we bring in on a per pound basis. So just keep that in mind. We continue to glean significant value out of the export markets. Some of the key marketplaces, just keep in mind, Japan, South Korea, they are two of our strongest markets year in and year out. They're our two biggest markets, but we continue to see significant product flow into places like Mexico, Canada. Obviously, one that's on everybody's mind, look at the top chart on the top right. Look at China. China since August has really kicked in. They've really kicked in. These are still small numbers. Don't get me wrong. They're still small numbers, but they moved into a new level. If you looked at exports to China since August, they've been our sixth biggest market. They weren't in the top 10. They weren't in the top 10 until we got into the latter part of this year. So they've really come on, and that's one that we're watching. It's going to take several years for China to be as big a market as what we see in Japan or South Korea, but one that is definitely worth watching, keeping on your radar screen as we move forward. Now, what about the competitors? What's going on with the competition out here? If you've looked at the data for total meat production on an annual basis over the last several years, beef, pork, and poultry production on an annual basis has been growing at the rate of about 2.5 billion pounds a year. We're only going to be up about 600 million pounds this next year. The big reason for that, look at pork. Pork production is going to be down somewhere between 2 and 3% for the year, 600 to 700 million pounds. Again, the pork industry, I think, is looking out here. They see China is in the process of rebuilding their hog population. After they went through African swine fever, we benefited greatly in being able to export a lot of pork into that market to help fill the void. We've also been exporting a lot of poultry. But as they come back online and rebuild their infrastructure over there, again, the pork industry is sitting out here and saying, we better cool our jets a little bit. Production will be down. This is the first time pork production in the U.S. will be down in several years. And as a result, what we anticipate is a 8 to 10% improvement in prices this next year. We're going to move back in here where we're approaching the same type of price levels for pork that we saw back in here in 2012, 13. Probably won't get as strong as we were at 14 when we had record high pork prices, but we will see a significant improvement from where we've been the last 2 years, as you can see here on the bar on the right-hand side. So again, the hog industry should see some renewed profitability. The pork market will have less competition in the marketplace. Again, that will bode pretty well for the beef market as we move into the year in total. The dollar is really getting in a position in here as it continues to weaken. Again, if you look at the dollar's at 2.5-year lows today, and it's weakening against most of these other key market currencies that we're watching on a regular basis. This just tells us that we're getting much more competitive. And that's why I said to you, if I was to lean one way or another on our export forecast, it's going to be bigger than what we're telling you. We've taken a pretty conservative view on our export forecast as we look at next year. We could easily be up 8 or 10% for the year in total with the way our currencies are matching up today. But with that, I want you to see what this looks like on an annual basis. This is beef, pork, and poultry exports. Again, pork exports have been huge over the last several years. China has been a big driver in this. You can see that pork exports have basically matched broiler exports in here in the last 12 months. Beef has been growing, but at a much slower pace than we've seen out of those other proteins. Again, some of the trade deals were put in place through the Trump administration. Even though they were painful getting there, they are going to bear some significant fruit for the meat industries, I think, as we look down the road. A lot of those trade deals that have been put in place are very positive for us, are going to open the door for continued expansion of our export markets as we look down the road. And I just highlighted one of those for you when you look at the Chinese marketplace. Now you ask, again, I know you all are getting bombarded by all this talk with fake meat and this and that, or people are going to quit eating beef, pork, and poultry. Well, I want you to see this in here as you look at where we are today. Look at 2020. Look where the bar was in 2020. Basically 223 pounds of beef, pork, and poultry consumption in the United States, the highest on record, the highest on record. Now, we're going to be down some next year, primarily because of the pork situation I showed you, but people haven't been walking away from protein and substituting a significant amount of the alternative proteins into the diet. That's not been the case. Again, you can look at this. This is all animal protein, so this is beef, pork, and poultry all combined. Market share for substitutes is 0.4%. If we look at it relative to beef, it's less than 1% if we just look at it from a beef standpoint. Now, I really believe we're going to see growth in each of these markets, but you need to understand when they're talking about these big, huge percentage growth trends, understand where we're starting from. These are very, very small markets. If we continue to do what we're doing and stay focused on quality, and we will continue to listen to our consumers and deliver the product that they're demanding with the attributes that they're demanding that are important to them today. They want to know more about traceability. They want to know more about sustainability. They want to know more about animal care. I know a lot of you out there have responded to that. I would say keep the pedal to the metal. If we can answer those questions, I don't think we should be worried about what's going to happen with these substitutes as we look down the road. So again, congratulations to each and every one of you on doing what you've done to make our product better. Demand is telling you we're doing the right thing. Look at this meat sales number that we've had in here through the course of the year. Now, this is thinking about COVID. I want to remind each and every one of you out here, pre-COVID, 55% of the meat consumption in the United States took place at food service. Restaurants, institutions, schools, colleges, sporting events, those type of things. 55%, 45% at retail. With the COVID scenario, we've had to move 9% more of our total meat consumption or sales through the retail channel. That's a staggering number. That's been an 18% increase in dollar sales at retail. They've had a hell of a year, haven't they? Again, they've had a very good year, but they had to double up. Think about the number of people they've had to bring into these operations to be able to take care of the added demand that we've seen at these retail counters. 18% increase in sales. Look at beef's share of the increase in spending. Nearly 45% of the increase in spending of that $11.5 billion came to the beef industry's bucket. Again, what that tells you is when you look at this, this is what I was sharing with you. You all know this. Don't ever forget this lesson that's on this graph. If any of you out here want to have one big picture message for our industry, we need to always remember where we came from. And it's a painful story. If you look at this graph from 1980 to 1998, that's a painful, painful story. Beef demand was cut in half. And it was cut in half because we couldn't respond to the consumer's demand for our product. We were putting products out there that they really didn't like that well. As we got focused as an industry, and I would put a lot of the benefit of the checkoff programs, the muscle profiling work, the quality work, all of the audit works that we've done on an annual basis, I think they've helped us get focused on what it is the consumer really wanted. And look at the change in demand that we've experienced as we've come through there. Look at the bar on the right-hand side, the yellow bar at 63. Contrast that to where we were back in here in the late 1990s. This is what I'm telling you. Again, the strongest demand that we've had in 30 years. So congratulations, but don't let up. Quality has been a lot of the driver on that. The beef's market share of spending. When you go back and you look at the increase in spending, spending has doubled since 1998. Market share of spending for all proteins is doubled. While it's doubled, beef has gained 7% of that total spending, consumer spending. We're getting 7% more of it than we were back in here in 1998, 1999, and 2000. A lot of that comes back in here, and this is how it should come back to you, is in the form of demand growth. Again, more profitability within our industry. Well, that's happened, hasn't it? When you go back and you look at this graph, think about the demand loss that we had in here from 80 to 98. Look what our profitability situation was in an industry. It's $32 a head. $32 a head that we had 4 industry segments to share then. The industry profitability number here over the last several years, again, the last 20 years, has been, obviously, it's significantly better than that. It's $300 and some a head. I don't remember what the average is off the top of my head. The bottom line is what most of you are seeing out here is, yeah, but look at the last several years. Look at the packer margins. Packers have obviously taken a much higher percentage of the total because of what I shared with you earlier. We don't have enough shackle space. Again, it wasn't a conspiracy. I mean, this was just a reality of economics at play in here. We needed the shackle space, so we as producers needed what the Packers had more than they needed what we had, and that's the reality of the margin situation. If you go back in here to 2014 and 15, when we had these huge margins in the producing segments, again, look where the Packer margins were. You can't even see them in here, can you? And that's why we ended up closing so many of those packing plants through this 2012, 13, 14, 15 timeframe. So this will shift. The important thing for you in the cow-calf industry to understand is we're not going to stay at these extremes long. They will start to move back in the other fashion. Some of this money will start to move back to the production segments. The bottom line is that the demand is already there. This is not new demand that we have to create. I think that's the real positive message for all of us to understand. Grain has improved 30% from back in here in the early part of the 20s. Since 2000 to 2005, we've seen a 30% increase in prime and choice grading. That's why the consumers are coming back. Consumers now with COVID have had a kind of a resurgence. There's been a whole new push in here for consumers to want to be able to buy a higher quality beef product at retail. Again, this is a significant change. This is new demand. When these restaurants open back up, obviously you're going to see demand for these high-end white tablecloth restaurants. You're going to see demand for prime ratchet right back up. But we're also going to continue to see more demand at retail for certified Angus beef type products and prime at the retail counter. You can see it very clearly on this chart. Even though we've increased the choice and prime grade the way we've had, the spreads have stayed strong, haven't they? These are the annual spreads. Look at the CAB spread here. And it shouldn't surprise anybody on this call. CAB actually was premium to prime this year because we didn't have that white tablecloth restaurant. So again, you're seeing some of these dynamics in the marketplace play out. I think that's a very, very strong message that we've held these premiums in spite of having these restaurants closed the way we have as we come through the year. Now, let's put a bow around it and talk through a few of these things before we open up for some questions. The commodity indexes, as we look out here, we've got a very inflationary market that is brewing here. Again, the Bloomberg Commodity Index, the CRB indexes, all of these indexes are breaking out to the top side. This chart is current as of yesterday's close. We're breaking out to the top side. We've got the dollar at the cheapest level. This is the dollar as of this morning. It's at the lowest level in 2.5 years and plummeting. Money's cheap. We're likely going to get more stimulus in here soon, not only here, but around the globe. All of that is inflationary. You need to expect the cost of doing business is going to increase. Costs are going to increase, but the prices are also going to increase, aren't they? So that's part of what's going to fuel this, and I think you need to make sure you take that into account. Look at the way the outside money is flowing back into these markets. This is outside money flowing back into the ag commodities. This is pre-COVID. This is back in the first quarter. We were sitting in here at 1.2 million. We're at 1.5 million and growing. Now, the cattle markets haven't shared very much in this just yet. They haven't shared very much in it just yet, but they will. Again, the story in the meats, as we start getting more and more people vaccinated, you're going to see a resurgence in confidence. You're going to start to see people moving around the globe. You're going to see more people on airplanes. You're going to see more people in hotels. all of those things are going to bode well for the meat industry story. So be prepared for the beef industry, the hog industry to join in this parade of more money flowing back into these markets. And I think you'll see that relatively quickly. Within the next 30 days, actually it started this week, in my opinion. You're starting to see a little more of that, but you'll see a significant change in it over the next 3 or 4 weeks or 3 or 4 months. From a seasonal standpoint, we would expect prices are going to be $5, $6 a hundred higher this next year, average 115 to 116, maybe 117. We don't think we need to trade cattle much below where we're currently trading. You know, we're selling a lot of cattle in Nebraska the last couple of days, 105 to 6. Hey, that's the low end of the range for the last several years if we didn't have a black swan event occurring. The highs for this next year, in our opinion, will be late in the year. We'll have a nice spring rally, but the highs for the year will be late in the year, again, which would be pretty typical when we get into this phase of the cattle cycle. For those of you that are stocker operators, we had to weather the volatility in 2020. We're looking for a nice recovery this year. I would say this is a conservative price level, but you're going to have a little bit of a difference. You got a tale of two halves. You still got plenty of cattle to get through in the first quarter, and then the market transitions as we move into the second half of the year. So you can see the range that I've described for you there. And again, this is looking at the price range on feeders going all the way back to 2017. With the exception of these black swan events, we really have basically traded cattle from 160 to 130 on feeder cattle. Well, we will be back up to the upper end of this range during the second half of the year. So again, some renewed profitability for those of you that are building feeder cattle in our production systems today. For those of you that are cow-calf operators, again, the Tyson fire hit us at a bad time last year, going right into the time period where we'd see the peak marketings of, for those of you in that business that are not retained owners. We've had the hangover all year long this year. We didn't get the seasonal rally. You can see this if you're looking at the green line. The calf market's been stagnant since March, hasn't it? Well, we bottom seasonally, just like we always do. I'll say it again. I know you're sick of me saying it, but if you're in the cow-calf business and you're selling calves in here in September, October, November, you need to quit it. You're selling calves at the low in the market 8 out of every 10 years if you're selling them in that window. So figure out a way that you can put more pounds on those cattle, grow more cattle, put them through the feed yards, retain ownership, and get paid for the genetics that you're producing in those cattle. Again, there's significant advantages of being able to take to participate in those margins at those other industry segments. And I challenge you to take a look at that if that's something that can work for you. As I look at the industry in total, again, the calf market's going to get higher this next year, but I think this is what you want to see. Is there something there that is coming that looks more positive? I'm just laying this out for you for the next several years so you can see our view. Now, don't get hung up on the absolute price levels. I want you to get hung up on the trend. These trends we're very confident in as we look at the demand and supply situation, the way they'll come together. Can I tell you with a lot of confidence today by 2024 whether we're going to be selling calves at 240 or 220? Heck no, I can't. But I can be pretty confident in the trend that I'm showing to you here. And again, we're back up in here selling calves at 210, 215, 220. We're finally going to put some profitability back here for our cow-calf producers. That really is, that's what we've got to have. If the industry is going to be healthy, the segment of the industry that's got to continue to be rewarded is the producing segment, because it all starts right there. So as I look down the road, that is one of the significant changes I believe we'll see. As I summarize it, I think I've covered it well for you. The numbers are going to contract. We're going to see less of an increase in total meat supplies here for the next few years as we go through this transition. Exports are going to improve. They're going to improve. I think they'll improve more than what we're forecasting this year. But again, just stay tuned, stay plugged into the update. We will once we feel confident in that, we'll make sure and share that in a weekly update so you can make that tweak in your forecast. Demand has been phenomenal. Best demand we've had in over 30 years. Hard to believe when you think about having all these restaurants closed as much as they've been this time through the year in total. Prices are going to be moving higher. And as I just shared with you, we think we'll see a significant improvement in profitability for all industry segments over the next 2 to 4 years. I'm not worried about plant-based proteins. Yes, they are going to gain some market share. But when you look at this, I want to make sure that you all are keeping in mind what's going on here. Global population is going to increase. It's increasing at the rate of 83 million people a year. Are we really going to be able to put enough animal protein in front of all of this increase in population to make sure that the nutrition level of this increasing population is met? I just really doubt it. I think there will be a need for some of this increase in plant-based proteins to help feed this growing population around the world. The thing I would really emphasize to you, though, is this last one. Consumers are going to continue to want more information about the source of their food, their animal care, the antibiotic use, the sustainability, all of those things. We got a great story. We got a great product. You can see how they responded to the quality improvement that we've had in the industry. I think you should feel fantastic about that. Just don't forget, continue to listen and hear what they're telling us. If we do that and respond as a people, as an industry, I think we're going to be in great shape as we look at the next 10 to 15 years. So congratulations to each and every one of you for your contributions to the improvement this industry has made. And again, I appreciate the opportunity to be with you, and I look forward to taking a few questions here.
Thanks, Randy. Now, if anybody has any questions, either raise your hand or type in the chat, and Randy'd be more than glad to answer a few. So Randy, hang on here and we'll see if we have anything else for you.
Read that. You see that, George?
Read that question.
Randy, we got a question. Randy, do you anticipate economic uncertainty drawing more money into commodities away from the stock market?
Oh, I don't think there's any doubt about it. I think what you're going to see is you're going to see an expansion of money flow, as I shared. We will see more money flow into commodities. We're going to be in a very inflationary environment here over the course of the next few years, with the way all of these countries' fiscal policy has been to try to navigate the COVID scenario. That's bullish commodities as we look down the road. So expansion of money. I would just say to you, I wouldn't necessarily expect that we're going to see this have a negative impact on the stock market. When you come through a recession like we have, regardless of the administration that is in office, when you come through the early stages of a recovering market cycle, you would typically see the equities markets improve 13, 14, 15% in that first year. And again, you would see that build as we go forward. So I would look at it that you're just going to see the commodities join the parade. We've had a heck of a run in these equity markets over the last several years. The commodities are going to get in on the act now.
Okay. Randy, we've got another question. How do you perceive comments from the incoming administration about changes in current trade policy?
As I look at what's going on in here with the new administration, as they kind of get themselves positioned, I really do not anticipate that we're going to see a significant change or move in a different direction from a trade policy standpoint. My guess is over the next few years, they will look at it more from a multilateral standpoint as opposed to a bilateral, unilateral standpoint. So again, the Trump administration is focused on going out and doing trade deals with, for example, with NAFTA. We broke it apart. We did our own deal with Japan. We did our own deal with Korea. I think what we'll see is a little more of a multilateral approach as we move down the road. And you saw that with what China just did with, what was it, 16 or 18 countries. I don't even remember what they call it, but I suspect we will be doing more of those type of things to stay competitive.
Okay. Anybody else?
You guys are easy on me today. Sure great to be with you, and I wish you all a Merry Christmas, and I really do want to thank you all. I want to thank you all at KLA for the support of Califax. I want to thank all of the members out there that have supported Califax now for the last 52 years. And let us know what we can do better for you. We're here to work for you. We take that responsibility seriously. And again, thank you for that opportunity. Rob, for those of you at Farm Credit, we really appreciate your support of the industry and what you're doing to help move this industry forward. So thank you again.
All right, well, Randy, thanks again. Great job like always. And I will also say thanks to Farm Credit Associations of Kansas for sponsoring this program.